Hi, I'm Eric.
And I'm Dick. We are the Annuity guys.
Dick, we've got a bunch of letters up there. I call it the alphabet soup question. How to avoid the 50% penalty from the IRS on your IRA RMD.
Well, I think everybody knows who the IRS is.
That'd be the Internal Revenue Service.
Individual retirement accounts, IRAs.
And then the one that sometimes people don't
required minimum distribution.
Yes, the RMD.
Yes. It's so important, Eric, because most folks don't actually realize or understand that they get a 50% penalty if they delay paying taking the money out of their IRA and paying the tax on that required minimum distribution. And that takes place at 70, your first birthday after 70 and a half. And there's a lot of little nuances to when you can actually avoid taking it out that year if you want and delay it into the next year, but then you have to take two out in 1 year, which can really up your income level. So you're better off to take it out that I think for most folks that first birthday, after 70 and a half. And the key is getting it out in a timely manner. Now the annuity companies, what I like about that is on an individual annuity basis, they will identify when the time is that you need to pay it, give you the options of when to pay it, and make sure that the right amount comes out for the amount that you have in the account.
Sure. So you've got the custodian taking care of you, basically.
Right.
And you see this a lot with even the brokerage accounts as well. That
Yes.
You've got the custodian that's overseeing your IRA. They're going to tell you, hey, reminder, you have to take your RMD. Mm-hmm. Now, I just want to be clear here. So we've got, in order to avoid this 50% penalty, I've got to pay a certain amount of RMD each year. And there's a table out there, the IRS
590. Yeah, yes.
So they state what the percentage is, and of course, they can change that at any given year, but they've got it out there. It's pre-stated based off of your assets as of December 31st the prior year. So you know what that RMD amount's going to be. Well, you could be, just have done it maybe 1 year. You could get to age 71, 72. It's your second time. You forget.
Yes.
So they're going to look at all your aggregate IRA assets. They're going to say, oh, you owe $4,000 maybe in RMD distributions.
Right.
Well, if you forget, guess what?
Well,
$2,000.
Plus, you've got to pay your tax. You're going to take the money out anyway. You have to pay your tax, and you owe $2,000 of what came out
is a penalty
to the IRS. And it's quite a contrast from when you're younger and your mind's working well, and you say, I want to take out a little of my money early, and you have a 10% penalty. Yeah. But for some reason, the IRS or Congress saw fit to penalize, folks when maybe their mind isn't working so well, 50% for not taking it out.
Yeah, you get to your 90s and you forget a few things, but guess what? You can't forget that. Otherwise, the IRS will come hunt you down and make sure they get their half.
Right, exactly. And one of the things that we like with annuities and we talk with folks about is that you tend to stage your income when you do proper planning with annuities. A lot of times you don't turn all of your income on at one time, but as you're staging your income, a lot of times by the time you're in your 70s, you've got a certain level of income coming out of your annuities that's going to more than cover your RMDs.
Right.
And it may be covering your RMDs for your investment accounts, so you don't even have to really give that much thought. Typically, folks, based on the publication 590 tables, you're looking at starting out somewhere around 3.5%, about 3.6, 3.65, and then it graduates up and increases with your age. So if you're starting out with an annuity company at the age of 70 taking an income of 5-6% or maybe even more, that's going to cover your RMDs for a long time and maybe about double what you've even got in that annuity. So it'd take care of some of your other IRA investment accounts.
Right. You got the annuity covering enough of a distribution.
Yes.
Because it doesn't have to come proportionally out of each account. It can come, your RMD can come out of one account rather than having to take it out of all 5 or 3 or however many IRAs you have.
Right. And we have many clients that consider doing it that way, having it come out of one account. And one of the areas that I have seen, Eric, that really trips people up is that first year sometimes, because I have seen some confusion when someone gets a letter they're not sure what to do with the letter. They just let it go. And, then amazing. The IRS is not lenient on this. They're very, very strict.
Yeah.
I still don't fully understand it, why we do this to our seniors. But just be aware, folks. And you can set these annuities up to really help out.
Sure.
Hey, why don't you talk about the longevity annuity?
Well, as I say, it's kind of the latest twist for folks that are, again, trying to avoid paying an RMD perhaps, or at least this way, we're saying delaying it so you don't have to pay it at age 70 and a half. The longevity annuity allows you to take up to a quarter of your IRA distributions, IRA account balances, or up to $125,000, whichever is less there, and put those pieces out there into the future up to age 85. So you can delay taking any kind of distribution, but you have to set it up as a deferred income annuity or a longevity annuity. So you're just putting those RMDs out there a little bit in the future, but it also is giving you an additional level of longevity insurance.
So Eric, there's an actual age that you have to start the income by.
But you have to start the longevity annuity by age 85.
And I think Uncle Sam figures that he needs to get that money out of there before he goes to the insurance company.
Right. Yeah. Now, if you set some kind of return of premium guarantee, or for some reason, the other aspect we should talk about is an inherited IRA.
Yes.
So if someone does pass IRA dollars on to a child or grandchild,
those have RMDs too.
They still have RMDs attached to them. And guess what? 50%. It doesn't matter. You just have to take them. And if you forget to take them, even as a younger person with an inherited IRA, you're going to get hit with half.
Yeah.
So be careful of the RMD monster.
Yes. There's so many things, folks, that you can do with the RMD concerns and utilizing annuities properly. And that's where it's so important to work with a good planner that understands about the RMD and how to really utilize that to your advantage. One way you can take those RMDs and invest them in life insurance. You can take the RMDs and I said invest, but it's really purchase life insurance. Some folks take the RMDs and gift it over to their children. So there's just many different possibilities depending on what your goals and your objectives are in your retirement planning.